Kia ora, everyone. My name's Nicole and I'm the Alumni Program Manager here at Young Enterprise, and it's an absolute pleasure to welcome everyone to the stream and to introduce you to Steph and Mason, who's filling in for Bex from Icehouse Ventures. So it's really cool to have these two along to share their expertise in the field around venture capital and some ways that I guess our audiences can pitch for funding for their companies, and also a few tips and tricks and things they've learned along the way. For those who are joining the stream live, welcome. We'll be sending this out to people to review the recording as well. So welcome to all those people who didn't make it on for the live session, but we're sure you'll get a lot of value out of watching the recording as well. So I'll quickly hand over to Steph and Mason, and they'll sort of introduce themselves and run through the wonderful presentation they've put together for you. If anyone has any questions throughout the session, feel free to put them in the comments, and we'll either answer them as we go, or we'll do a little bit of a Q&A session at the end. So chuck them in the comments, and we'll get to them as we go through. So we'll pop Steph and Mace on screen now. Hey team, welcome. So if you guys want to kind of take it from here, and we'll kick on.
Hello. Sorry, I just stitched someone up. Messenger. Kia ora. Thanks, Nicole. Welcome. I'm Steph, and this is Mace, not Bex. Unfortunately, Bex is sick today, but the awesome Mace is joining in. Yeah, I've been in the startup space for about almost a decade now, which makes me feel old, but I started when I was like 18. Worked at Young Enterprise, worked at Creative HQ, running programs that encouraged young entrepreneurs to find what they were passionate about and start businesses through that. Now at Icehouse Ventures, which we'll talk a little bit about today, and I run communities, so support the companies that we invest in ways beyond capital to help their companies grow. So that's me. Nice.
Hi everyone, my name's Mason. I'm an investment principal at Icehouse. Sorry if you're expecting Bex. She's currently sick, so I'll last minute replacement. Similar to Steph, I've been in the kind of startup space for a while. I first joined the team back in 2017 at the age of 19, and I've been there kind of since. My role is mostly kind of sitting on the investment team, meeting a lot of companies, leading investments, doing due diligence, and working with our investor community. Yeah, so that's a bit of background on myself. So I think we'll kick things off with a bit of background, I guess, on Icehouse Ventures. The story of Icehouse Ventures, so we've originally started in 2003. We have gone through a number of kind of evolutions of how we invest in startups. We originally started in 2003 as basically a couple of investors got together, wanted to kind of syndicate and invest in companies and work together to do due diligence, invest together. So we basically acted as the managers for that and formed an angel network, which is how we kind of invested for all the way up to 2016. So basically grew the group to around kind of 300 members, investing kind of $2 million per year. And then in 2016, we raised our first seed fund, which was a $10 million fund, and began to switch the model to become more of a traditional VC firm fund manager. So since 2016, we've raised around kind of $300 million in funds and have become one of the largest and most active investors in kind of Kiwi startups. Yes, that's a bit of background. Steph.
Yeah, sounds good. So a bit on our mission, which explains a little bit about the entrepreneurs that we back. So the words like aspiration, transformative, and brighter future really define what a VC is. So we'll talk about it a bit more, but we're investing and work with founders who are incredibly ambitious people. They've got really broad and exciting views of what the future is and what they think it should be. And they've got the skill sets and unique insights to execute a solution to achieve this. So we'll explain it a bit more soon, but that kind of sums up us and what we do.
This is probably just a follow on from what we do. This is a bit of a snapshot of kind of where we're at now, just by the numbers. So I guess a couple key metrics would be, I guess, the portfolio companies. So basically since 2003, we built a portfolio of around kind of 306 companies, which is quite a significant index of like the New Zealand tech landscape. We probably have some level of exposure to kind of key companies in the space. The next is probably our investors. So we're a bit unique relative to other VC firms where we have a large volume of LPs or investors in our funds. So we have around kind of basically 2,400 investors across our funds, where majority of VC firms probably have a lot less than that. The reason why we kind of have a opted into having basically a low minimum investment to our funds and having a high volume of investors is the strategy of basically having a lot of aligned people to the kind of mission that kind of Steph mentioned earlier. So these people range from exit entrepreneurs to professionals and everything kind of in between. And we leverage that network of basically being able to provide kind of value to our startups. And I guess another kind of key metric is total invested. So since establishment in 2003, we've invested kind of roughly $348 million into kind of Kiwi startups. Cool. I guess the kind of first question and the most important question is kind of what is venture capital? In the kind of simplest forms, venture capital is a form of financing, mostly investing in kind of startups and kind of or kind of small businesses. We'll talk a bit later on about kind of what those kind of typical companies look like. But venture capitalists such as ourselves invest funds into startups in exchange for ownership, a percentage of ownership into the company, so equity or some form of ownership. And those funds that we invest basically go allocated towards growing the startup. So either that be kind of product development, hiring employees, or kind of sales and marketing focused, and obviously varies across every aspect. So kind of due to the high risk, I guess, of investing kind of in this asset class as a venture investor, most investors are kind of drawn to startups that kind of demonstrate innovation and advancements kind of in technology. They have the kind of potential to disrupt kind of industries and generate a kind of significant return back to investors. So it's kind of the balance of kind of risk and return is quite on the other end for kind of venture and investments. Other than capital, most of the kind of support that venture investors do is regards to kind of strategic guidance, kind of mentorship, opening up the network to the companies. And as investors, you are kind of a part of the company in some form of ownership. So basically working to provide the best resources to those companies to succeed and kind of achieve their mission is kind of what a venture investor is.
Cool. And I know we're here to talk about venture capital investment today and how you could potentially pitch for it and what you need to prep. But it's good to acknowledge that there are plenty of other ways that you can fund your businesses. And venture capital is really suitable for a certain type of company, typically a company that needs a lot of funding in order to be successful and over a really long period of time. So it might be taking a long time for that before they get revenue. So the real thing is, unless you really, really need venture capital, I personally would not recommend pitching for it. There's plenty of other funding options, and each have their pros and cons. So one of those could be bootstrapping. So that's putting your own resources in. So that might be personal savings, and then continuously reinvesting the profits you make in your company so that you can grow sustainability. This method allows you to maintain full control of your business, which is a massive pro, and avoid taking on that risk. But it can take longer to grow that way. It's best suited for like product and service businesses. So you might use some of your personal savings to develop a product and then sell it online or sell it in a store. And then use the profits you're getting from selling that to invest back and grow into that business. For a startup, so when I say holding off on raising venture capital, it's really good to bootstrap for as long as you possibly can. So if you're looking at building a SaaS platform, like a website of some form, or you're developing some form of technology, consider what you could possibly do at a really minimal cost using the resources you have, the knowledge you have, or the networks you have to validate that you're onto something with that idea. So you've got a really great case for when you go to investors. Other options are family and friends. So it's really common if you might have a business idea to go to your family or someone in your network and ask for some money. Obviously, pros to this, it's usually like in kind. There can be cons to that. It's very, you want to treasure those relationships, and money can always make things difficult. So make sure you just set out some really good guidelines if you're going to do that, in expectation that they might lose their money. So they've got some understanding there. Crowdfunding is another great one. So if you've built a really great community, so you might have some followers on social, people that love your product, that's a really great way to crowdfund. So you can go out to that community and they can provide some money in order for you to build that business. There's different ways they can do that. They might take some ownership. Other ways it can just be out of the kindness that they want to do. So platforms like Pledge Me, I know Anna Gunther is a Yes alum. That's like a really great one to use in New Zealand. Business loans, it's quite traditional and better suited for more traditional companies as such. Banks can be, there's a lot of stuff that goes into getting a loan, obviously, and they'll typically expect quite a thorough business plan, an idea of what you're doing and how they're going to get their money back. Grants are an awesome option for young entrepreneurs. There's so many out there. You can look on Ministry for Youth Development, Callaghan Innovation have some great grants. Grants are just money that typically have some form of theme or purpose behind it. So it might be to support young entrepreneurs, it might be to create more sustainable solutions, and they are typically, in some case, free money. They're not taking any ownership of your company or expecting you to pay that money back. It's generally just to support your mission. So my advice would be check out as many grants as you can before raising money. There's so many available out there, and founders and companies continue to get grants. Doesn't matter how far down the journey they are. There's so many for different stages. And then once you start getting more into the investment space, there's angel investors. So they're typically high net worth individuals who have some form of, they might have been successful by starting their own business, they're an entrepreneur themselves, and they want to invest their money and support another founder, and they'll typically take some ownership of that company too. Angel investors are actually the types of people who invest in our funds to then invest in a range of companies. So plenty of funding options out there. Totally recommend researching which ones you think are suitable for you, and you can use more than one, obviously, throughout your business journey. Then,
cool.
More about VC funding.
Yeah, well, back to VC funding. So we'll just could we talk about just a few kind of the kind of type of companies, I guess, that receive VC funding, with just a couple kind of examples of startups who have received funding recently. So kind of good one to do a bit of a deep dive into is Kiwifibre, which is a company that Steph and I led investment into last year. And basically what they do is, I was founded by kind of two Canterbury University students who develop high performance natural fiber composite materials, basically kind of using natural fibers to replace the use of artificial fibers such as like carbon fiber. So they utilize harakeke, which is New Zealand flax, and through that have kind of developed a lot of different solutions or replacements, kind of leveraging factors such as being renewable, so it's better for the environment, can be produced cheaper, it has stronger tensile strength, and it's radio transparent, so leveraging a few other lot of different features. So why they kind of raised investment? So they were very bootstrapped and got quite far actually without actually raising much money. So I think they had invested around $500 into the company themselves. Used leverage kind of like friends and families to use their kind of machines and kind of did everything as kind of cheap as possible. Got through R&D that way and developed a product which they got to a point where they were actually kind of pitching kind of multi-billion-dollar kind of multinational firms and kind of had built quite a big pipeline. So the reason why they needed to raise capital was because they kind of proved market validation by kind of I guess showing that the demand was there by kind of building a good pipeline. They kind of had to deliver on those on that kind of demand and basically bring the manufacturing in-house and deliver on those kind of early customers as well. Yeah, as well as kind of build up the supply chain element of the business. So I guess why did we invest in the company? First of all, it comes down to the founders. We were really impressed with Ben and Will as founders and kind of the unique insight they've developed and figuring out that Harakiki kind of has these properties that can outcompete other solutions, which is, again, probably the product as well as probably a big component of why we kind of interested in invest, as well as kind of IP around the business as well of being, I guess, being unique to Harakiki being New Zealand based, as well as their kind of IP strategy around that as well. Let's go to Partly. So the next company that is VC, or is a kind of VC backable company is Partly, which is the company that builds tools and data sets to connect buyers and sellers to the automotive industry, which is one of the most kind of fragmented and least digitalized areas in the world, which is which is a massive kind of data problem, which they've solving in the process of solving. We've kind of first met Levi, who's actually not on the screen, when he was building a different startup, which was a competitor to Trade Me. And through that process of building that company, realized that the highest volume of kind of inventory that they're dealing with was automotive parts, and discovered the kind of the problem of data that was getting in that industry. So they kind of found a really unique problem. It required kind of scale to be the first to market to kind of solve it. So the investment was basically kind of to help build the product and kind of get early kind of first adoption into the market, as well as it being early traction just because the problem was so strong that there was a clear market validation of the kind of problem they're solving. And why we invested was basically because how big the problem was, and the team again, and the kind of 1.9 kind of trillion market size that they were trying to tackle. So that's a bit of a kind of a summary of kind of two companies. If you were to summarize that into what is a VC backable company, it comes down to probably three things, which I've probably touched on in those kind of descriptions, comes down to the founders, which is the kind of unique insights and relevant skill sets they have to build a big company. So in the kind of case of Kiwifibre, it was the unique insight that they found through their research at university of the properties of kind of Harakiki. And with Partly, that would be their kind of unique insight by having built a different startup, found a different problem, bigger problem that emerged in the kind of automotive space. The next key thing is market size, which is, so as a venture investor, you kind of have to look at a startup that can deliver, it's big enough opportunity to create a kind of 50x return to the investment. And the only way to do that is kind of having a big kind of market opportunity. So in Partly's case, the kind of the automotive parts ecosystem problem is a $1.9 trillion market, and then the textile market, the kind of composite market, I think it's like a 1.5 trillion market, and the natural fiber composite is around $10 billion. So a big enough market that a company can basically be built into it. And defensibility is what basically kind of makes it hard to replicate. And why they can ask the older question, why hasn't someone else done it? Or why can't someone else do it? In kind of Kiwifibre's case, that comes down to kind of patents and intellectual property, as well as being unique as being it's a New Zealand kind of product and only Harakiki's grown in New Zealand. And Partly, the defensibility comes from their kind of network and integration with other suppliers and the unique access to data.
Nice. So going back, I think before to explain the types of companies that we do back. So these are typically the areas that VCs invest in, and I won't list them all, but we'll send the slides out afterwards. But I think the commonality goes back to they do require a lot of capital typically to start and scale. So for a software company, it might be that they've got that validation and that they need to hire a team in order to execute and scale really quickly to launch into new markets, etc. Other companies such as deep tech, which seems to be a space that's becoming more and more popular, and some really great companies emerging in New Zealand around that. A lot coming out of the outset space up in Auckland. Things like aerospace. So for example, Dawn Aerospace, a Christchurch company, they've got really big ambitions to build more sustainable form of space travel. So rockets typically go up, they come down, they crash. It's really expensive and unsustainable, not friendly to the environment. And so they've got really massive ambitions, but they've got really clear steps in how they're going to get there. So first they built their first product, which was a propulsion system that can move satellites around space. And so that's an easy thing for them. Well, typically an easier thing for them to get to market than a space plane. And so they started that generated some revenue, but that still required a lot of R&D and capital costs up front. And it's going to require a lot of costs over the years. And so that makes them a great example for a VC to be able to back that, because we can back from the very early stages when it's just an idea and a bit of validation, right through to IPO, so when they go public or when they exit later on. So Dawn launched that first product, and then they're working on space planes as their next one. So they can launch into space, but then come back down to Earth and reconfigure and go back up again in a more sustainable way. So lots of different things that can be launched in order to achieve a bigger mission, but typically it's quite capital intensive, these companies. So companies you probably couldn't start with personal savings or a bank loan, because I don't know if banks would finance building rockets. Areas that we don't typically invest in, and I think it's really good to note when we say we don't invest in these companies, us not investing in something is no correlation to whether or not it's a good or bad business. We turn down so many fantastic businesses that are having great traction. They've got their customers love them. They've got a really good product and they solve an important problem. It really comes down to it doesn't fit the economics of a venture fund. We're not the best investors for that business. There's other avenues they could get. So things like consumer products or arts and films, we don't invest in those things, but that's just because we stay in our lane, and there's other ways that these types of companies can raise investment or get funding to do what they want to do.
Cool. So I guess if you go for all that information and then you get to the end and you realize that venture capital is the avenue to finance a startup, this is a bit of a summary of like what to include kind of in an investor pitch, or what kind of information they've prepared when you go out to kind of raise capital and meet investors and going to discuss your startup. So the kind of key thing is not to, you don't need to have like a lengthy business plan or very like a lot of information. Sorry, just a lot of information. I mean, like an excessive amount of information. This is the kind of key details that an investor kind of looks for. As most investors kind of look for a lot of pitch decks and startups, having that really concise and clear structure is pretty essential. But the key things is basically to look, first of all, map out the problem. So what is the kind of key problem that the startup that your company's solving? Then the solution. So how is your product or startup you're building going to solve that problem? And then the unique insight is kind of why has no one done it before, or what don't people know that you know of how to solve this problem, or if there actually is a problem, identify the problem is a unique insight. And why now is it comes from why now is multiple things. It's either kind of trends from technology development that what was possible 5 years ago is now possible, and or kind of any other kind of trends. Market size is what I was referring to before of how many kind of how big of a problem is it, that how many people does it affect, and who are those people, and is it big enough, or why is it big enough to kind of build a big business from it. And then the next thing is kind of where the kind of businesses as it stands, by what has been built today. Is it the product at MVP stage, or is just kind of idea stage? Kind of how many customers have you talked to? Do you have revenue? All those kind of questions of just like kind of where the kind of company is currently, how big, what the team is, who is involved, advisors, current, previous investors, etc. The plan, which is kind of what does the next 12 to 18 months look like? What are the kind of key objectives that need to be achieved? Where would the business look like in 18 to 24 months time? On the assumption of raising capital, the budget refers to where the kind of money is spent. So say you did raise $1 million, $500,000, $100,000, where would that be allocated to, and where will that get you to, which kind of again refers back to the plan of, if you raise $1 million, this is where how many customers we're going to target of getting on the platform, where the product is going to look like, etc. That's right. Sorry, that's all right. And then once that's the kind of initial pitch deck, which kind of like is the first kind of contact from an investor. Once the investor's kind of interested in the company, this is kind of a level of documents or information that they kind of will look at for the kind of due diligence process, which is again goes back to the budget, but kind of more refined, more detailed budget of actual month by month, what the expenses are, and what are kind of like costs, and where do you think the revenue is going to go? So kind of forecasting your financials. The other docs is just trying to get sufficient comfort in those, or basically back up those claims that were made in the kind of pitch deck, which is kind of proving the market size through market research, the problem by customer interviews, again technology, kind of the defensibility of the startup of the company, in regards to patents, IP, the employment roadmap. So who do you need to hire to kind of deliver on those objectives? The go-to-market strategy, which is once you raise the capital, what does 18 months look like? How are you going to get in the market? And tech roadmaps, what the product's going to look like over 18 to 24 months time. Actually, I got sped through that really fast. So Steph, let me know if I like it. If you want to touch base on any of those things. But yeah, this is like the kind of key documents that like will go to the next stage of what an investor looks for before making an investment.
Yeah, it's good. It'll be good to share the list afterwards. So those documents really come into play once you say in week 4 in those due diligence questions. I just spotted one of the spelling mistakes that came up from another pitch. So this is how we explain our timeline at Icehouse Ventures of the process of raising venture capital. It's really good to note that if you are going to raise investment, it always takes longer than you expect. And this process, like this 12-week process, is typically once you're a little bit prepared. So you've built relationships with some investors, you've built a relationship within the startup community, you have those documents ready. This running smoothly is all subject to multiple things. So we typically try and make decisions really quickly. So once you meet with our team, it's either a quick yes or no with a bit of feedback, or actually a quick no with a bit of feedback if it's not a fit for our funds. Maybe keen to introduce you to the team and learn more, or a yes, we need some more information from you. And so when we talk about meeting a second sponsor, that's typically someone else in the team. So we just got a backup of our opinion or a different perspective on the company. Presenting to an investment committee. So every VC will have an investment committee, and they're typically made up of partners within the firm who have the power to vote yes or no to an investment. So they make the final decision. on whether or not we invest our money. Then there'll be some due diligence questions. So that's typically those types of questions arise from more information that the investment committee want to know. A term sheet outlines the criteria of their investment. So we're going to give you this much money, and in return, how much equity, so how much the percentage of the company is exchanged for that, what the valuation of the company is, which I'm not going to get into valuations today because it's really subjective and so many things to it. So worth Googling though, and just other perspectives. So lots of the time, term sheets, we outline how we're going to support, etc., and just different things. So term sheets are typically negotiated. Also, there'll be a bit of legal due diligence, and that's when hopefully all the documents get finalised and we can transfer some money into the startup's account. And so I thought I'd give a bit of advice just on before entering this process. So it's worthwhile meeting investors and other founders who have raised some money. Ways to do this is like through accelerator programs, participating if you have in Young Enterprise or other programs around the country. Your universities might run programs that are helpful. Coming to talks like this or other startup events is useful, because some of the most successful ways of raising investment is through warm introductions. So another founder that we've invested in might say, I know this founder, would you be happy to meet with them and learn about their company? Or we meet through programs and that we work with. And it's a really good habit to get into of start tracking some key metrics, so you can really build relationships with investors or people that could be supporters of your company to show, I've had this idea, I've put some work in, and I can see it working, and this is why. And build up that before you raise investment, because it can make raising investment a lot easier later down the track. So you can just share the progress. You don't always have to have a coffee with these people. A quick email. I put an example of a format I received the other day that I was really impressed with, from a founder who I met with last year, introduced him to some of our team, had a great company, but wasn't a fit for our fund, so we declined it at the time. But he came back, he sends me his updates regularly, every few months, and he came back the other day being like, it's been a while since we talked. They'd increased their revenue dramatically in that time. They'd been accepted into a really great program where they were learning about a new market. They'd signed on some cool customers. They were considering raising later in the year, so they just wanted to touch base and keep me updated. They suggested a catch up, but there was no pressure to, and I think that's a really great way to do it. I did jump on a call with them, and it's always good to catch up, but it also means you're just cautious of everyone's time and also your time. You don't need to be jumping on coffee catch ups if there's no real outcome for you. It's just helpful both ways. So yeah, that's just a good way to start building those relationships before you need the money, because it's much easier to come in when it's warm. So yeah, do you want to talk, I guess, now a bit about First Cut, which is a way to build those relationships? I guess, Max, do you want to cover it?
You can cover it if you want.
Okay. Well, Max and I work on First Cut. And so First Cut's a community of entrepreneurs under 30. So obviously Young Enterprise has a fantastic community of young entrepreneurs, and First Cut is really designed to complement any other program that you might be doing, whether it's university, you're working, you're participating in Young Enterprise. And it's applications are open at the moment, and so kicking off in April, participants will have access to a series of virtual workshops. So the founders of Dawn Aerospace, or some of the team from Halter, or the founders of The Curve, some really cool entrepreneurs will all be speaking on their journeys, so you can all learn from. And then it's a way of preparing you if you wish to raise investment or consider other forms of funding. We'll also be doing some in-person workshops around the country in May, so worth checking out if you're keen to learn more. So yeah, that's us. Any questions?
Cool. Thanks, team. That's real awesome. I think it's so cool to have you guys sharing your expertise and actually, a really wide-ranging presentation in such a short time. So really impressive. So if anyone's got questions, chuck them through in the comments and we'll get them put up on screen. We've got a couple that have come through for you guys, so I'll just chuck them up so everyone can see them. And the first one is, how's the pandemic impacted your approach to venture capital investing? And I guess what changes have you guys seen since COVID-19?
I feel like this might be a good one for you, Mace. Being on investment.
I think actually a lot. So actually in both avenues as well, from investing as well as the the startup side as well. COVID introduced a real catalyst for innovation during that period, where obviously you saw remote working and this kind of globalization of being able to easily build teams overseas. So you saw a bit of trends of kind of Kiwis coming back to New Zealand to start a company, just because it was a more preferred environment to basically live. And as well as it kind of opened the barriers for talent. So by talent, I mean like key employees. So you're not restricted by like a 10-kilometer radius of your office. You're kind of opened up to hiring people overseas, and this development of remote tools being easier to build kind of companies remote. So you saw that. You saw also in regards to venture capital itself, you saw a large growth of kind of capital investing in this asset class. I don't know if it was driven by that. It was either from just the market investing in the space, but you saw a large increase in volume in New Zealand during that period, such as ourselves as well as other kind of investors in the country. Anything else to touch on that, Steph?
No, I met with a founder this morning that had started her business in COVID. It was a COVID startup, which there's some cool ones from it.
It was also a common period where people started like just because they had spare time, I guess, and started building companies during the pandemic. So 2020 was a really interesting period in the startup world.
Yeah, I think it's good to know it probably didn't change our approach to venture capital investing. Like that's always stayed quite similar and what we're looking for, and the companies that are getting funded, it's still very similar. The great ones will still raise money. So there's just a few different things, but yeah.
Cool. Thanks, team. We have one other question that's come through, so I'll chuck that up on screen. So I guess specific to you guys, what if any, I guess, support do you offer companies beyond the funding? And I guess are there resources or networks that you kind of offer on top of the funding?
That's great. That's a really good question. Steph, do you want to?
That's why I gave you the other question, because this is more my job. So as well as being on the investment team, my role is head of community. And so that's all about what support can we provide a company post-investment to help them grow beyond capital. And so there's a few parts to that we do. So talent is a big one. So we run events like Careers of the Future to showcase how awesome startups are to work for, and then help build a talent pool to connect great people with the companies that are looking to hire. And then helping with resources and things. We've just, one of the new additions to our team, she's an employment lawyer, so just helping in that space. Another part is just founder connections and events. So one of the most important and valuable things we see is just founders meeting with each other and learning from one another, because no one quite understands the journey like a fellow founder. So we do some retreats each year. We take away a great group of founders. We do founder dinners quite often, and just other ways. Another part is just on operations. So the problems these founders might be solving is unique, but running a startup, each can learn from one another, and so there's ways that they can do it more efficiently. So connecting them as operators with each other so they can learn from one another on how to scale businesses. And then another huge asset is our investor network. So they've all got expertise on their own. So it's really helpful for us to be able to connect founders and their teams to people who have been there, done that, so they can learn from one another. So that's some of the community support that we do offer our companies. I don't know if you've got more, Mace.
Yeah, also probably leads to another good point of it's important as well as for a startup to do their own due diligence on their investors. It's most common, like you think of like a founder doing investor doing due diligence on a company, but that way around as well, because all capital is the same. It's like the real difference in investors is the kind of value that they provide other than the money. Is like kind of real difference between like a startups as well. So it's key to like and as well as an investor kind of joins your company as being on the cap table. So I think it's quite key to make sure you have the best aligned investors on the journey as well. So doing your own due diligence is kind of key as well.
Yeah, I think that leads quite nicely into the next question.
Here's the next question.
Yeah,
what are the funds
good questions. So I think it's good to note that the competition in the VC sector really makes for a better outcome for founders. So it's, all of those offerings to founders is improved, and the behavior of investors is always really important and key, that all founders are treated with respect. So that helps with the competition. But it's also good to note in competition, we typically co-invest. So we won't tend to take up a round by ourselves. We'll want to invest with others, just so you've got access to more expertise, and later on down the track there's access to more capital as you need it. So there's really great VC firms in New Zealand. Blackbird's recently entered the market, so they're an Australian VC. There's the likes of NZGCP, so they're more of a government one, and then Movac, which are a later stage VC, and they've been around for years. One of the partners of that's been my oldest mentor, who used to be on the board of Young Enterprise, so a great group there too. GD1, all of these really great other VCs in the New Zealand market, and we're lucky that we do get to work alongside them, as well as sometimes competing in a friendly way.
I love that, competing in a friendly way.
Yeah.
Awesome. I think that's all of our questions that have come through. So I guess, as you guys mentioned, we'll send out the slides, and obviously this recording will be available beyond this session. But I guess, do you guys have any sort of closing thoughts or anything to wrap up that you just want to add in to the present?
Actually, I don't. Sorry.
That's it all.
That's it all.
Thanks for having us. It's always great to do things with Young Enterprise.
Yeah, cool. It's been really awesome to have you guys, and thanks for giving up the time for this session. I'm sure we'll have a bunch of other things to talk about, and hopefully we'll have a few other webinars for everyone tuning in. So there's always some things going on, and there's always some opportunities we can share with people. So thanks again, Steph and Mason, and good on you for stepping up at the 11th hour. But cool. Thanks, team. Thanks everyone for tuning in. We'll send out a link to everyone who's signed up. And then obviously we'll make this available so people can see the wonderful work that Icehouse Ventures are doing, and maybe we'll see some of you coming through and pitching for some funding, which is always good.
Looking forward to it.
Apply for first cut.
Exactly, first cut. So we'll put the link in the comments for first cut as well, so people can access that whenever needed.
Cool. Thanks so much, Nicole.
Awesome. Thanks.
All right, thanks, team.